Okay, continuing our lecture for Chapter 1, I want to review accounting basics more. You should know the types of accounts. Many of you guys learned this in Business 1 as dead coil. I didn't learn it that way, so I don't teach it that way, but that will certainly help you. The 7 types of accounts we talk about are assets, which go up with a debit. Liabilities obviously go up with a credit. Owner's equity accounts go up with a credit, as do retained earnings accounts. Other accounts in there include revenues, which go up with a credit because they're good for retained earnings, so they're like retained earnings. Expenses obviously go up with a debit, and so those are like asset accounts. And of course, common stock goes up with a credit because it's an owner's equity account. And hopefully you guys remember income summary as well, which is very much like revenues. They go up with a credit, go down with a debit. So there's 7 types of accounts. It's certainly not limited to 7, but those are the most common ones. I think I left out dividends. Dividends go up with a debit because they're like an expense. Okay, so I hope you know those, and certainly dead coil does work for that, for remembering those accounts. Okay, you should know which ones are temporary, which ones are permanent. Anything that shows up on the balance sheet is permanent, and from the income statement, obviously, revenues, expenses, and the income summary account, which you close those 2 accounts to, that is a temporary account. Also, dividends are temporary, so those need to be closed at the end of the period. So anything that's closed at the end of the accounting period should eventually trigger an entry into a permanent account, usually through the closing of the books at the end of the accounting period. Okay, so please understand that closing process, which we'll get to in a minute. Adjusting journal entries. This is one of the most important things that accountants do because so many of these adjustments at the end of the period are not triggered by an invoice. The adjusting journal entries are actually something the accountant must remember to do, whether it is writing down unearned revenue or actually earning it, whether it is prorating insurance and making sure that you have taken care of expired insurance, prepaid insurance that is, and all kinds of different adjusting journal entries. Okay, so please understand all these examples of those adjustments. So hope you remember that from Business 1. 10-column worksheets. I hope you remember the unadjusted trial balance. Okay, the closing of the books, which triggers a couple of more columns in that worksheet, and of course the adjusted trial balance and how those trigger various entries into the income statement and into the balance sheet accounts. So hope you understand 10-column worksheets. Closing the accounts. You close revenues to income summary, you close expenses to income summary, then you close income summary, which closes to retained earnings. And the critical step there is that when you close the income summary account to retained earnings, that's where the temporary accounts actually trigger an entry into a permanent account, namely retained earnings. The 4th step in closing accounts is closing dividends, which also closes to retained earnings. And there you have it, 4 steps for closing accounts. Finally, we hope in Business 1 that you understood merchandising and inventories, LIFO and FIFO, and also the merchandising details with purchase and sales discounts and returns and allowances processes, and also hopefully you understand what cost of goods sold is, what profit margins are, and hopefully a multi-step income statement, which I believe is on page 201 of the book, although the book changed, so I may need to change that page number. So double check, multi-step income statement. Okay, that is pretty much it for the Business 1 review. I hope you had some petty cash, some over and short review. I also hope that you remember bank reconciliations. Those I hope are fairly easy steps, but basically you're balancing the cash on your books with the cash balance on the bank's books, and once you add the pertinent info to each side's books, there's information that you know about that the bank doesn't know about. There's information that the bank knows about that you may not know about, so you have to reconcile those differences, and hopefully they balance out perfectly. But that's about it for Business 1, so I'm going to stop this lecture here, and we'll go over to Part 3 and the new material in Chapter 7 in just a second.